All right, welcome back. It's time for the afternoon session. I'm really excited to announce our next keynote speaker. I've met him last year in New York at a conference, and I thought he'd be a perfect fit for what we're doing and trying to achieve here. Like I mentioned in my intro this morning, that we're trying to educate and really try to paint a holistic picture of what is going on in the world. You've been reading a lot of headline news about critical minerals, whether it be in the Ukraine, in the Congo, what is happening on that side of the metals or the commodity space. And I couldn't have found a better speaker. It's Kwasi Ampofo. He's with BloombergNEF, and I've flipped through his slides earlier today. And I think he's going to answer a lot of our questions in terms of supply chain. What does it look like on the copper side, demand and supply? So, Kwasi, really appreciate you being here. Thanks so much, and floor is yours. Thank you.
Thank you very much. Yeah, really appreciate being here. I think the part of the introduction he didn't mention was he came after me in New York, right? And yeah, by the time he finished, everyone forgot what I said because he was very good at it. So thanks so much for having me. And yeah, so I'm going to talk today about critical minerals, certainty in uncertain times. And I think when I was invited, for me, a big part of my job at BNEF is we help our clients really understand the role metals will play in the energy transition. And I was told that it's a very gold-heavy audience, so I came in very early in the morning to learn, and I was very happy when there was a presentation on graphite. So I focus mostly on the critical minerals. I do very little on the precious metal side, with the exception of PGMs. So yeah, so I'm going to break my presentation into two areas, right? The near term and then the longer term. So for us, when we talk about the near term, we're looking at everything in between today and the next 3 years. And for us, the most important thing, first as a producer, but then also as an investor, is that the economy underpins everything that we do. And I noticed the earlier speakers spent a lot of time on what the Fed decision is, what it means for interest rates, what it means for inflation and all that. So it's pretty much the economy that drives whatever you see or whatever activity you see on the stock market. So I asked myself, what are some of the two broad indicators if I were to take a view of the market in the short term? So the two indicators I settled on was manufacturing and construction. Every time you see a crane, as an investor or even as a miner, every time you see a crane, you should probably have a smile on your face because you do know that at the end of the day, they'll be consuming the raw materials that matter to you. So we sort of on the left-hand side, we look at the manufacturing activity indicators, and we stretched it back to the peak of COVID in 2022. And you can see that we've actually not recovered significantly for these in terms of manufacturing. What that means is that, yes, we've seen demand, but then it's actually not gone back to where it used to be pre-COVID. And you can say same for construction as well. So the blue color you see there was US. The US has been an outlier in the developed market. I still don't know why, whether the Inflation Reduction Act, whatever it is, there's a lot of construction activities. And I think there was an earlier question about real estate from the audience in the US. It's really, it's been on steroids, which is pretty much the opposite of what we've seen in other developed markets as well. So what does construction and manufacturing mean? And I don't know if anyone has heard the term Dr. Copper. Simple reason being that copper pretty much underpins the global economy. And I'll be making a very interactive session. If you feel I'm saying nonsense, please put up your hand and do tell me, and I'll revise. So if you have any questions as well, feel free. If not, we can wait till the end as well. So we looked at the impact of these two activities on the copper market. And you can see that in China, copper concentrate imports grew significantly, even though there's a squeeze in supply. We all saw what happened in Panama the last, I think a year or two ago. We've all seen the fact that the top three producers of copper at the moment are Chile, Peru, and I think the DRC. And at the moment, we've not seen the significant level of growth in there. So smelters are actually operating under utilization as a result of there not being enough supply. The refinery market looks a bit different. At the moment, we saw refined copper import in China grow significantly. And then we saw same for semi-final product as well. It might as well be the fact that towards the end of 2024, there was that assumption that President Trump was going to win the election, and that could lead to tariff wars. So a lot of companies decided to do their imports from China before 2025. But then we can see that final copper product actually grew marginally compared to the rest. Copper treatment charges, it's an indicator of where we think prices would be. And you can clearly see that treatment charges are falling because most of these smelters are actually not getting raw materials in order to process. So what does this mean for supply and demand? And this is quite very interesting. And for those of you in the investment markets, look, I chose copper because, like I said, copper is pretty much the story for every other commodity. Every other CEO that will come up here will be facing a similar thing. On the left-hand side, you're looking at demand. And on the right-hand side, you're looking at primary supply. The world is not fallen yet because of recycling. But I always have a test I use, right? How reliable is recycling? Let's do that. How many of us have a mobile phone? Okay. How many of us have used more than one mobile phone in our lives? And how many of us have taken our old mobile phones to recycling? So I'm going to throw a question. Is recycling a reliable alternative to fill this gap? The question is no, because I think one out of the multiple people here have actually ever taken their phone back to get it recycled. So that means that we still need a lot of mining for copper and most of the other commodities that you're interested in. But why are we not building them? It's because of prices. So on the left-hand side, yes.
Coming to the copper supply.
Yes.
There's a lot of talk about the copper discoveries in Zambia.
Yes.
Do you think that will be some kind of game changer on the supply side?
So on average, it takes about 10 years. I think yesterday I was in Brussels and someone gave an interesting stat in terms of permitting timelines. It turns out the US was last but one in terms of how long it takes between discovery and production. And according to the speaker, the country that came last was Zambia. Yeah, so permitting timelines is actually a big challenge in the mining industry. On average, it would take about 10 to 20 years between discovery. You look at mega projects like Oyu Tolgoi, even Kamoya, that is sort of a poster child in the DRC, took about 20 years from discovery to full production. So, yeah, it's not going to be easy in Zambia or any other jurisdiction, as a matter of fact. Yes, please.
One question. I've seen different versions of that chart for the last 10 years, and it just seems to every year shift forward. Why is it different now?
Yeah, so it's different now, obviously, because there are three solutions to this, right? You either dig more, you recycle more, or you reduce consumption. And we've done very well by reducing. So that's the Dr. Copper, whatever decisions central banks take actually affect consumption. I mean, there are people who will not buy their second car. So we've done very well at reducing consumption, or to a large extent, even reducing, substituting in the case of grade with aluminum. But there's a theoretical limit that you can actually get to where we cannot say we will not travel again because of increase in or deficit in the market, or central bank cannot just take interest rate from 5 to 10%. It becomes just counterintuitive to slow down consumption. So at some point, we might have to look for new mines, bring them up to speed, or bring them into production as quickly as possible, or this is what's going to happen. Every year, or actually every quarter, Bloomberg goes around asking industry experts, analysts on where they think prices will be. The highest and the lowest, yes, please.
Price depends also on the loss.
Yeah. So, but then that's what, in my experience, right? Those are the sentimental ones are very short-lived. So, for example, there's tariff agreement between China and the US that moves the needle for 2 days, 1 month, but then in the long term, it comes down to the fundamentals, the supply and demand story of the market. But they do move prices in the near term. So the group of analysts Bloomberg reached out to, some think that this year, copper prices will fall to 8,000. That's the most pessimistic view. But there was actually someone who thought copper prices would be 15,000. Our view is somewhere in the middle, right? And the question I always ask is that, at what price point do you think would incentivize new production to come online? Is that price point 10,000, 12,000? And our view is that it's in between these two numbers, $8,675 and 15,000. And that's what the junior miners are calling for in order to see a lot more activity from, for example, retail investors in the junior space for us to develop those new mines. If not, we might have to slow down consumption because there's not enough supply to meet demand. So as investors, if you could develop a dashboard as to how does the economy affect your investments in the mining space, what are the 3 things that you should focus on? What I think is be on the lookout for China's economic slowdown. It's very important. It affects all the companies you have exposure to, and it also affects all the companies you're looking to have exposure to. The US tariff barriers, I cannot keep up. Before I prepared this presentation, it was, I think, 100 and something on China. Now I'm told it's going to be 30. But do keep eye on it, because it's data that actually affects life. It's data that actually affects investments. And then the final thing is Europe's defense spending in the near term. Whatever happens, because essentially, like I said, whether it's fighter jet, whether it's drones, whether it's better communications for defense, it's all about raw materials. So we're going to talk about a little bit longer term, right? Because like I said, it takes about 10 years on average to build a new mine from discovery. So the next 3 years will be uncertain, but there's some certainty in the longer term. And that certainty comes out of 2 reports we publish, the New Energy Outlook and then the Long-Term Electric. So it's pretty much transport and infrastructure and how they impact raw materials. So collectively, we combine that view to develop what we call the Transition Metals Outlook. And if you look at the cover page of the Transition Metals Outlook, it tells you our priorities that we think copper will play a very key role. So what will be the drivers of demand? So we looked around us and we asked a fundamental question. Whether it's transport, whether it's solar, whether it's power grid, or whether it's aviation fuel, we're going to see a significant amount of growth in demand for all of this. We at BNEF, we have 2 views. There's obviously the net zero scenario, which, depending on which part of the world you are, will be a top priority for you as a government. But then we also have the base case scenario, which is purely based on economics and technologies that exist today. And regardless of which of the scenarios you want to focus on, the key fundamental is that there is going to be growth. Now, mostly, of course, preaching to a choir here, but then I've been to places where, actually to be specific, in San Francisco, and I was giving a presentation, and halfway through my presentation, it occurred to me that when I was talking about mining, people actually thought I was referring to data mining. So just full disclosure, I'm talking about mining as in bringing out rocks. But then that tells you how detached institutional investors and everyday people actually think metals is one thing and our way of life is another thing. So this is actually one of my favorite charts, that there can be no energy civilization without raw materials. Metals is at the heart of everything we do. So whenever you think about building a new gas plant, a new nuclear plant, a new, even coal plants, it actually has an interface with the raw materials that matter. So if we collectively agree that mining is at the heart of everything, what does it mean for demand? So there are 2 things I'm going to share with you. That demand for metals will grow significantly. I'm quite optimistic over the long term. But then the second thing I also want to leave you with in demand is that technology development would have a very key role, okay? if you look at the last 100 years, the way we produce steel has not changed. Okay? So if you took your position in how steel is produced the last 100 years, you come back 100 years later, and that market is still certain because there are steel mills in the US that have existed for over a century. Now, 4 years ago, if you were bullish on electric vehicles and you believe that a nickel-based battery used in electric vehicles will be the dominant player in the market, fast forward 4 years now, that's no more the case. It's the iron-based one. So the second thing I want to leave you with is that as investors, there was a time where it's just good to know the supply market because the demand never changes. But this time, you have to know the supply and the demand. And I think that's one of the reasons why Kai probably invited us, so that we talk about the evolving demand and what it means to your investment exposures as well. So now let's start with demand will grow. Like I said, we all know that demand for metals will grow significantly, whether it's storage, transport, grids, or wind. In absolute terms, this is what it's going to look like. 350 million tons of metals needs to be produced. Aluminum, copper, some are more important than others. But then the narrative there is that everyone who comes on stage today and tomorrow has a great story in terms of demand. But here's where it gets interesting. Technology. On the left-hand side, you're looking at our view on chemistry. So think about your internal combustion engine, on your Autobahn. There are some cars that use diesel, and there are some cars that use gasoline or petrol. Similarly for battery, not every Tesla uses the same battery. There are different battery chemistries, and those battery chemistries are made up of different metals. I actually have a not-so-funny joke about, if you look at the auto companies, most of the auto companies named their companies and product after themselves. Ford, why? Because I'm Henry Ford. When it came to naming batteries, they realized the importance of metals that they chose to name the batteries by the dominant metals, not by their names. So every letter you see there is a metal. LFP, lithium iron and phosphate. NMC, nickel, manganese, and cobalt. 2022 on the left-hand side, that was our view of how we thought the market will evolve. When we did that same exercise in 2024, you can see that the colors have changed. We thought the green, the iron battery phosphate will be 30%. Now we think it will actually be more, about 60% by 2035. And there are two schools of thought. Either we got better at forecasting the future, or the market evolved very, very violently over that 2-year period. And the latter is what is happening. And this actually has an impact on whether there will be a market for the mines you invest in, whether it's cobalt, nickel, or lithium. Yes, please.
How do solid-state batteries fit into that environment?
Yeah. So the battery, every battery has a positive and a negative. So the positive is actually the cathode. You're looking at the lithium, and then the negative, I think Nouveau talked about the graphite. When you charge the battery, the ions flow from one point to the other, and to discharge, they flow from one point to the other. So the electrolytes that transfer the charges in between discharge and charging are liquid at the moment. Now, that is going to be solid. So it's still the same minerals, it's still the same metals, but this time the electrolytes are just solid. What that means is that you pack a lot more energy into the battery for less metal. So it's just going to reduce demand, but it actually doesn't change the chemistry. Same battery chemistry with a solid electrolyte instead of a liquid one.
And what about the potential silver solid-state battery?
The silver one?
Silver, yeah.
Yeah, so I'll talk about the future in a minute, yeah, but there are emerging technologies coming up. So platinum as well is going to change significantly. We've seen hydrogen come up, and for those who know the use case for platinum, you can see that it reduces emissions. And platinum palladium, to produce electrolyzers to build all the optimistic hydrogen forecasts that, for example, countries like Germany have. You need a lot of electrolyzers, and electrolyzers depend a lot on platinum and palladium as well. So there's a great story there. Despite their decline in transport, we do think that electrolyzers will lift them up. There was a time where every grid company would use copper, But if you're saying copper prices could reach 15,000, great companies will start looking at alternative. Aluminum conducts 60% compared to copper, but then at 15,000, it makes sense that they switch or substitute, which goes back to your question. The forecasts keep changing every year because when prices go so high, it's a natural order. Consumption is substituted for something cheaper. And next generation battery technology. So at the moment, there are those anodes that are looking at graphite. I think Nouveau mentioned that. There are those that are looking at silicon. But how many of us know that at the moment, the Chinese companies are in the lab developing lithium metal as an anode? So the market is evolving, similar for electrolyte separators as well. So there are the companies that are looking at all solid states there, I think to answer your question. And they are looking at totally different polymers and sulfides. And of course, artificial intelligence. I don't know if that's a warning for time. Maybe not. Artificial intelligence would also grow our demand significantly as well. So I've painted a picture of demand, right? It's going to grow, but it's going to be complex. And as investors, it's not enough to know supply anymore. You need to understand the demand to be sure that there is a market for the project you're investing in. How about supply? So similar to demand, I have two things to share with you. Supply bottlenecks vary, but exploration holds the key for our civilization. So what are the supply bottlenecks? This is a very complex slide. Let me try to explain it in a few seconds. So we took a very hypothetical scenario. If, for example, we stopped investing in primary mines today, which product would grow into instant deficit? And you can see here, with the exception of manganese and I think cobalt, where there's overcapacity in the market, if we stop building new mines today, this is how the market is going to look like. Because we are hoping that the pipeline projects that are being developed are able to produce. And the key thing here is that we should not get complacent with junior miners, because they hold the key to a deficit. And mostly when I talk about deficits, it's very difficult, I think, for everyone else to understand what it means for them. And I always use an example. So this is an instance where President Trump talked about children using $2 instead of 30, right? That's what deficit does. So let's do the simple math. Let's say all of us wanted to change our microwave or our mobile phones every year. Unfortunately, the price of the metals that go into a mobile phone doubled. The cobalt, the nickel, everything else doubled. So Apple would have no choice than to increase its product from $1,000 to $2,000. How many of us would still be able to afford a new phone every year? That instantly changes consumption, right? So that's what happens with deficits. If we don't build new mines, prices go high. If prices go high, or if metals go high, the prices of the end products go high, and it affects our quality of life. So the mining problem becomes an everyday problem for us. So it's important that we keep investing in new mines. I'm gonna skip this, but then it's just really talking about green steel. Everybody loves green steel, but then green steel needs a different kind of iron ore, and that's a supply-demand imbalance. There's not enough of it. So once again, explorers hold the key. Manganese. At the mining level, this is the demand for batteries used in manganese. At the mining level, the assumption is that, oh, there's more than enough. But then at a refinery level, you need the highest purity of manganese to be used in batteries. That's how much capacity is in the market. So the second thing is that, yes, for some metals, even when you have you've solved the mining problem, the refinery and the midstream problem still needs significant investments as well. So who can help us? I think we shouldn't underestimate the power of explorers. The market has been tough, but there's optimism in the market. And that optimism needs to come from investors. And mostly, especially in Europe, I was in Brussels yesterday, like I said, everybody's talking about recycling. But then we think there's a theoretical limit to which you can actually meet demand from recycling, and it varies by metal. Nickel, yes, you can recover a lot of it for batteries, but then for metals like aluminum, palladium, it stays between 20 to 30%. So that 70% needs to come from a mine. and those mines need money. So once again, a very hypothetical question we ask ourselves. If we stop discovering new ore bodies, at what point would we run out of deposits? With the exception of iron ore and bauxite, every other commodity will be gone by 2050. So it's important that we keep adding new discoveries to our geology, once again, to prevent mobile phones and cars doubling in prices because of their raw materials. So I decided to self-appoint myself as a spokesperson for the junior miners. Any junior miner in the room? Oh, okay. Well, I'll still speak for them anyway. What do they need, right? And I think there's a misconnection between Brussels understanding what junior miners need or Washington understanding what junior miners need. So I came up with this triangle. I think juniors need three things in order to thrive and in order to be able to deliver their return to investors. They need your money, so please don't forget to take out your checks and invest. They need good policy from Brussels and Washington and Beijing and everywhere. And they need to care about the environment. Because there was a question about the younger generation, will they fall in love with gold or mining, like they've done with other asset classes? I think they would. But then we need to do an introspection as an industry as well. So these are the three things I'm going to spend the next 4 minutes to talk about. Now let's talk about the checks. If I was to go around with a hat to ask you how much money the juniors actually need, how much do you think will be needed to fill that supply-demand gap? I came with a number. Trillions. It varies across metals, right? So I think the key take-home for this slide is that no one country can solve it. Inflation Reduction Act is not enough. The CRMA is not enough. For 1.7 trillion to build the mines we need. And this is just for the energy transition technologies. We need quite a lot of investment. In absolute terms, that means between 2024 and 2030, every year $115 billion needs to be going in the mining industry. And if you look at Kai's early presentation, that is not the case. And once again, back to my equation, if we ignore mining, we are actually kicking the inflation can down the line. Because prices of metals go high, when Dr. Copper goes high, everything we buy goes high as well. So as investors, if you were writing your check, what are the criteria? I came with a postcard for you. As the junior miners, are their technologies de-risked? As the junior miners, are they in advantageous project location? Please ask them. Do they have demand for their products? Because like I said, in the old world, you didn't need to understand supply because the steel-making technology would not change for 100 years. If you're investing in a battery metal, you should also know about demand because it evolves quite quickly. And the final thing, that's the area they're working in as a skilled workforce. Let's talk about policy. What can policymakers do to help junior miners? I think it's important. There was a point earlier on about if two companies were coming together in Europe, would Brussels allow them to control more than 30% of the market? No. So if government would not allow two companies to merge and control more than 30% of the market, why have we allowed this? Why is China dominating every single metal that we use? So what can governments do? Coordinate. They need to work with you, investors. They need to incentivize. They need to have a skin in the game. Any government official here? Thank God. They need to build the mines. Build. And please work with partners, right? Major demand centers, it's important. I think one thing you should also ask the junior miners is, do they have strategic partnerships now matter? Because it guarantees demand and it also guarantees cash flow. Countries are evolving. There will be a time where China is not the fastest consumer of critical raw materials. Southeast Asia will. And depending on how you want to interpret the slides, other regions are emerging as well as demand centers. So quick, remove barriers, provide financial incentives, provide fiscal incentives, targets and regulations, and provide technical resources as well. Final thing is environment. Metals or mines exist in, I think, less than 0.1% of the world's surface. But then the irony of nature is that 0.1% is mostly found in some of the most biodiverse places on Earth. So if we want Gen Z to fall in love with our industry, it's important that mines adopt standards, operate in environmentally sustainable ways that protect national parks, protect lakes and wetlands, protected zones, and also protect inland waters. And our data is that if you expand existing mines, it's not just the revenue that increases, you also impact the negative effects of mining as well. So if you forgot about everything I've said the last couple of minutes, what are the 3 things you can do to support the junior industry? Please give them cash. They need good policies, so send the message across. And also to attract the emerging generation of retail investors, we need to ensure that we develop mines in line with evolving standards. And with that, thank you so much for your audience. And I don't know if I have time for questions. If not, I'll be around.